Welcome back to EDS, and in this video I'm going to show you step by step how to implement a proven strategy that's going to allow you to make money every single week, month, year. So the first thing you want to do is just pull up your brokerage platform, and the one that I'm using is tastytrade, and there is a native default watch list here. There's two really, 52 week near high, 52 week near low. We're just going to go with the 52 week near low. This means that every stock or every underlying on this watch list is near its 52 week low. We're simply just going to make the play assuming that the price is going to revert a little bit and move higher. Okay, but the way that we're going to do it is going to be very smart, and it's going to give us the highest probabilities of success. So what we want to do is, once we've got our watch list open, we want to have IV rank open as well, because this is not only going to be a directional play, this is also going to be a volatility play, and that's going to massively boost our success. So once you've got IV rank open, you want to order every underlying on this watch list from high to low IV rank, and you only want to look at things that have an IV rank of at least 30. So everything on this list has an IV rank of at least 30. Over 30 is high, over 50 is very high. And the reason why we want IV rank to be high is because the higher the IV rank, the higher the IV. And IV, or volatility, has a role on option prices. When volatility is high, option prices are high. And we are going to be short some options contracts, or we're going to be net short even some options contracts, and that's going to give us exposure to volatility. And when we are short, we are selling high, buying low. So we want to sell when option prices are high, i.e. when volatility is high. This is why we like a high IV rank. And volatility is mean reverting, and it's contracting in the market about 80% of the time. So we've got a good chance of things working out in our favor when IV is high. So I like to be anywhere, in the sort of mid to high range. We're going to have a look at MVO because I do know that MVO hasn't had the best time recently. As you can see here, these lines are from a previous position that we had on with MVO. That's why I'm a little bit familiar with it. But as you can see, MVO has been getting beaten up pretty bad. So let's go back over to our watch list. It has an IV rank of 44.4, an absolute IV level of 40.2%. It's currently trading at just over $83. So MVO looks good to go. And we're going to go over to the trade tab. And we simply want to pick an expiration date. This is a list of option expiration dates. We want to pick one that's 30 to 60 days out in time, and we want it to ideally be a monthly expiration date, not a weekly or quarterly, unless if the underlying itself or the options market for that underlying is very, very liquid. Say if it's something like SPY, the Qs, Apple, Microsoft, Tesla, then quarterlies and weeklies would probably be okay. But generally speaking, the monthlies are it's far more liquid. So that's why we want to stick with that. And we're going to go with March 21st. There's 30 days left on this contract. So we're going to open that up. And obviously now we can see the options chain. I'm not going to go into too much detail about what this is. There's plenty of guides or, showing you what the options chain is, but we've got calls and puts, and we have our delta. You also want to make sure you have delta on your calls and puts. That's going to be very important. Now, because we're near the 52-week low, we're going to make the directional assumption that price is going to not go much further, or hopefully even go higher. So we're basically being the contrarian here, and we want to we're going to hope that market or price reverts back to its mean. Now, what we want to do is we want to sell a put. Okay, we want to sell a put. Now, you might be thinking, this is just a cash secured put. This is not a cash secured put. This is in a margin account, and I'm going to show you how to really boost your returns in a second. So when you're just taking one side of a trade, you want to kind of be around the 30 delta mark. If you're taking both sides, i.e. if you're selling calls and puts, you want to be around the 15 to 20 delta mark. So we've got a 34 delta here on the put side at the 80 strike. So we're going to sell that. Okay, we're getting a pretty good chunk of premium here. As you can see, for the next strike out, you know, we'd be collecting 76 cents, whereas now we'll be collecting $2.05. The mid price is now actually $2.07. So as soon as this order gets filled, we would collect $207 on this position. We've got a pop of 70%, which means there's a 70% chance of making at least a penny on this trade. If we wanted to get out 50% of max profit, we've got a 79% chance of being able to do so. Now it's gone up to 81. And that's pretty much the trade setup. Now, our broker is going to require $2,400 in buying power to open this position. Now, you might be thinking that's not a high enough return for you, or that's a lot of money to allocate, and that's fine. So what I'm going to show you is how to basically eliminate those problems. Maybe you have a smaller account. Maybe you want to be more capital efficient. So what you want to then do is use some of this premium here, $2.05, to buy a contract further out. Okay, so you want to buy a contract as far out as possible, and we're going to explain why a little bit later on. In fact, I'll explain it now. So basically, naked positions give you the highest daily P&Ls. As soon as you cover your position, your P&L significantly drops, and the wider your spread is between your short and long position, or essentially the closer you are to a naked position, the higher your daily P&L will be. So that's why we always want to be naked if we can, or be as close to naked as possible. But if you have a really small account, you don't really have the luxury of being able to do that. So you probably want to go with the closest strike available, further out from the short strike, which is at the 75 strike here. $5 wide spread between 80 and 75. So we're going to pay 79 cents to basically cover our short here. And what that's done is it's limited our loss to the difference between the spread, which is $5 minus the premium that we collect up front, which is $1.28. You multiply that out by the contract multiplier. For equities it's 100, and we get our max loss number of 372. And our broker knows this, and now it only requires $372 as opposed to the 3,000 that it was before. So now, as you can see, we are far more capital efficient. We're going to collect $128 up front. Our broker is going to require $372 to open this trade, and in turn for doing this, our pop has dropped to 66%. Our P50 has dropped a little bit, but not by much. We're still at around the 80% level, so we're still getting pretty good pot odds here. Now, as I mentioned, you want to be, as wide as possible. You want your spread to be as wide as possible to get your highest daily P&L. So, for example, if your account can handle more than $372, you could go to the next strike. And now we're not paying 79 cents; we're paying 26 cents. So we get more premium up front. Our buying power requirement has increased because our max loss has changed. It's now $10 minus the premium, times by 100, which is 819. Our max profit is 181. But if you notice, our pop and P50 numbers are slowly increasing and getting better and better. So if we go to the next strike out, this isn't really too good of an example. Pop numbers are staying pretty similar, but you'll pretty much notice on most underlyings that the wider you are, the higher your pop will be. So in this instance, it wouldn't actually be a bad idea to be in the $5 to $10 wide range. And the reason why our pop isn't going down much further past the $10 spread mark is because if we look at our deltas here, our deltas are significantly dropping off. So it's not really making too much of a difference on the numbers. But generally speaking, if you're selling a 30 delta, you want to be around between 5 and 15 on the long side. So short the 30 or 25 to 35, and long the 5 to 15 range, depending on your account. And then further beyond that, there's not really much point. If you are just going to go more than that, you may as well just go naked or tighten up your spread a little bit. So that's basically the trade setup here. And how do you know how much buying power you should be allocating so you know how wide you can go? Well, in order to figure that out, we've created a free position sizing template. The link is in the description. Click the button and it will take you over to this spreadsheet. The way it works is you simply just enter in the size of your portfolio at the top. Say if it's $50,000. And then below you can enter in whatever the current VIX level is, and everything will be calculated for you. And all you need to do is just use this information to form the backbone of your portfolio. It will tell you how much buying power you should be allocating to naked positions, covered positions, or on this spreadsheet it's undefined and defined risk positions. Everything you need is here. As long as you follow this, you'll be fine over the long run. If you would like to learn in more detail about what we do and how we do it, again, link in the description. This time click on EDS Premium, get yourself signed up. Inside you will have access to our portfolio that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's also a private community, so if you ever get stuck, you can speak with myself directly or with other like-minded individuals. There is a 100% money back guarantee, so once you have studied the full course, followed our trades for 6 months, if at that point you're not profitable, we'll work with you for free until you are, or you can just request a full refund. So there's no risk to you. Right now it's $9.99 a month to join. The price was £1. That was for our first wave of members. That's now full. We're on the second wave. Once the second wave is full, the price will be increasing again. So you are rewarded for getting in early. However, whatever price you get in at, that's locked in for you. So you don't need to worry about future price increases once you're in. The aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill. Once you've learned it, no one can take it away from you. And we want to get you to that point of where you are self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.